Focus now on the corporate conversation. Ashish Jakhanwala, Chairman and Managing Director and CEO at SAMHI Hotels, with us today. Ashish, thank you so much for speaking with us here at NDTV Profit after what has been quite a positive quarter. Revenues were up 21%, operating income up over 81%. Margins have also bumped up a fair bit. And net profit has come in at 12% versus loss of 88 crores. Now, this is coming in a quarter which is not necessarily the best for your space. The best is yet to come in the current quarter we are. So what has really worked?
A bunch of things actually for us. First of all, thank you for having us on the show. We've seen that our presence, which is largely in the core commercial office markets, has done really well. And we've seen even the RevPARs, forget the accounting numbers, but even the RevPARs have moved up really well, both in Q1 and Q2. And we really don't expect that to kind of slow down anytime in near future, just because the office absorption in India remains to be very, very strong. You know, markets like Bangalore are seeing 14 million square feet of net absorption. And that's a pretty strong number for a year, really, you know. So I think that's a core theme for SAMHI, that our presence in the core office markets is really helping us perform well. We had acquired a business last year, which is ACIC. That acquisition integration is going well. That's contributing to a fair bit of the revenue growth that you see. We had recapitalized the company through an IPO. That's obviously helping us bring down both our debt and finance costs. And obviously, in addition to that, our cost of financing has also been coming down every quarter for the last 4 quarters.
You also had higher other income, which has helped this quarter. Finance costs have come down, of course, nearly half, from 114 crores to 56 crores. I'm just wondering if this continues, Ashish. Is this something that you focused on, showed this quarter? What about the way ahead? Will you see a further reduction in finance costs going away? And of course, the impact of this other income goes away as well.
No, so I think you will see finance cost is pretty much stable at this point of time for the next few quarters, because we have rationalized our leverage. Our cost of financing has come down. So I wouldn't say that it will materially keep changing every quarter. It will remain fairly stable and healthy for the next few quarters. That's one. Other income really keeps changing every quarter, but the main focus is that we continue to see very strong revenue growth, and we see very strong flow-throughs to the bottom line. So what we would see actually is very strong EBITDA growth, with both depreciation finance costs remaining pretty stable, and that will help us deliver higher net margins over the course of the next few quarters.
It's also Samina joining in. What percentage of your current portfolio is in the upper and upscale segment, and how do you see that mix evolving over the next couple of quarters and few years? And also, what stood out for me is Bangalore and Hyderabad. Your revenue per room has, significantly gone up 2x from what I understand. Is this sustainable, A? And do you expect this similar impact, or I don't know what you've done, but do you see a similar sort of trend across your other geographies?
So I think first, let me take Bangalore and Hyderabad. I think they are easy picks, First of all, if you see, as I just mentioned earlier, Bangalore is one of the largest office markets in the world today. It has about 200 million square feet of occupied office space. And to be operating in a market like that with very little new supply, I wouldn't be really surprised if we continue to see very strong RevPAR growths. Hyderabad is just behind Bangalore. It's about 100 million square feet of office space size, and again, with negligible new hotel supply. So some of these large office markets are well poised to provide a very strong RevPAR growth. So I've answered your second question first, right? Going to our upper upscale, if you see the total revenue contribution of that segment is about 45%, but in terms of room count, is just about 25%. We have about 1,000 rooms in that segment. What's going to fundamentally change between now and, let's say, 2028, 29 is the number of rooms that we have in our upscale segment is growing from about 1,000 odd rooms to almost 2,000 rooms. And that includes the 500, 550 rooms that we've added in Hyderabad and Bangalore, the acquisitions we've done, plus some of the conversions we are doing of our existing hotels, which will move from upper mid-scale to upscale. So we would actually see a significant growth in revenue per key of SAMHI, not just because of how the markets are growing, but also because of the fact that our upscale inventory is almost doubling, starting now and probably ending somewhere in FY 2028-29,
Ashish, let's talk about looking forward, expansion and aggressive plans that you've got. And you've, of course, gone on and approved the acquisition of 100% stake in Inmar Tourism and Hotels. What synergies do you expect from this acquisition? When will this be revenue accretive? And this is coming in at a ticket size of upward of 200 crores. How do you plan to fund this?
So first of all, the acquisition has been completed all from internal accruals. So we have completed the acquisition. It has been done from the cash that we hold on our books. Inmar has an existing operating hotel, and therefore, starting Q3, its revenues will start getting added to our overall revenue. They're not substantial because it needs to undergo the customary rebranding that we do in all of our acquisitions. Just understand the plan for this acquisition. So what we have signed with Marriott, that the existing hotel will be operated eventually as a part of the Tribute Collection, which is a Marriott brand. But we're also adding a new block of hotel adjacent to the existing operating hotel, and that will eventually be operated as a Westin. So we're actually going to add a Westin and a Tribute. Collective inventory between two hotels will be almost about 340, 350 rooms. So we have a substantial growth coming in the Whitefield market in Bangalore, and with two very strong brands, one of them being Westin. And all of the capex that we will incur in this renovation, rebranding, and construction of the Westin Hotel, which is the new block, is going to be funded from our internal accruals and cash flows.
You know, you've highlighted planned capex of 70 to 80 crores in Bangalore and 180 to 190 crores in Hyderabad. From where we stand, are there any risk of overshooting these estimates? Because a lot of times what we've realized is, you know, the cost that you finally incur comes in much higher than what you set out to do. And this is not just for hotels, but also for homes.
So I'll tell you, if you do greenfield development, then I have always cautioned people that disclaimer is a statement of facts. You know, it's not just a hypothetical risk. But we don't take development risk. If you see both in Hyderabad and Bangalore, we're talking about existing buildings, which we are going to fit out to be either rebranded in case of Bangalore or completed as a hotel in case of Hyderabad. And we've been doing it for the last 13 years now. So given the fact that we're really not taking significant development risk in both of these assets, and the fact that we've done these renovations over the last decade quite successfully, we feel that the capex guidance that we've given is we're very confident about achieving that, especially because there's no per se development risk in both of these assets, really.
Ashish, looking into the next quarter, I know revenue per room has been consistent, but also varies across quarters, right? Not just for you, but for the industry as whole. Where do you see revenues per room growth at in the next quarter?
So our view, and we've kind of articulated it several times before, on a consistent basis, we see the total revenue growth being in high single digits to early double digits. I think that's sustainable, not just for the existing quarter and the Q4, but also I feel for the next few quarters to the next few fiscal years, right? So we think given the demand supply dynamics across key Indian cities, maintaining a high single digits to early double digits total revenue growth it's pretty achievable. I mean, I think there are a lot of levers which will help us beat that, but I would like to make my business plans on high single digits to early double digits.
High single digits to early double digits, and of course, run the risk of outperforming or under-promising and over-delivering would always be a good thing. You know, I don't know whether you mentioned this, but with Whitefield hotel expected to generate 0.4 to 0.45 crores per room, when do you anticipate these assets becoming operational and contributing to revenues? Can you give me a timeline? I don't know if you mentioned it and I missed it.
So really there are three assets that will go live between Bangalore and Hyderabad. The first actually is the existing Inmar asset, which is branded Trinity. It's an operating asset as we speak, but it will eventually be rebranded as a part of the Tribute Collection in the next, I would say, 18 to 20 months, right? So that's the first lever. The second would be the hotel in Hyderabad. And I must mention that we've actually acquired an existing office building on a 40-year revenue share lease. And this would potentially be one of the first office conversions to hotel. And that's going to be branded as a W Hotel by Marriott. We expect that to be opening somewhere in FY 2027, so FY 27. And then the additional block in going back to Bangalore Whitefield, which will be branded as a Westin, is something that will take about 3 years. So we have really strong growth coming, as I said, you know, in a phased manner, starting from the rebranding of the existing Inmar asset, which is 142 rooms, then converting the office building in Hyderabad High Tech City into a W Hotel, It probably will be the first W outside of Goa in India and the first office conversion. And then eventually we'll deliver the Westin in Bangalore as an additional block in FY28 to FY29.
Right, Ashish, one quick question. How do you plan to scale revenue from variable leases from 13 to 20%? You want to just walk me through that? More agreements expected from your quarter?
So variable lease is an interesting way for us to grow. I wouldn't call it asset light, but it's clearly very capital efficient. We don't put the money up for land and building. We don't take any risk of paying a fixed rent over a long period of time. We just pay as a percentage of our revenue. Right now, before Hyderabad, all of our variable leases were in the mid-scale segment, which is Holiday Inn Expresses. With the W, it's the first time we're taking a variable lease model into an upscale. And as you know, the revenue per key in an upscale is probably 3 times that of in the mid-scale space. So as we add more upscale hotels through variable lease model, we're fairly confident that we will get to about a 20% target where our portfolio will be on variable leases, which is highly capital efficient.
Thank you very much, Ashish. Good talking to you. Good luck with business going ahead. We'll hopefully catch you next quarter. For now, it's all looking up. And congratulations on the recent agreements as well.